Welcome to another deep dive. We're here again to, cut through the noise and get you the insights you really need. Today we're tackling something interesting in tax law. It's called the Kiddie Tax. And it starts with this question, right? Can parents just shift their income over to their kids to, save on taxes? Sounds maybe a bit clever. A loophole.
Yeah, it sounds tempting.
Because kids, well, they're often in much lower tax brackets, sometimes 0% even. So why not let them handle the tax hit? But as you'll find out, it's not quite that simple. The tax code has some pretty specific rules to stop that, especially for unearned income. It can get a little complex, but stick with us. We're going to unpack it. Okay, but before we really dive in, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we're talking about today, it's all derived from the great accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely check out the website. They've got practice questions, videos, tons of support to help reinforce what we covered today. And a special thanks to Professor Farhat for providing all this valuable material. All right, let's get into it. What's the real problem the Kiddie Tax is trying to solve? Because let's be super clear on one thing first. Parents absolutely cannot just assign their earned income, like their salary to their kids.
No way.
You can't just walk into HR and say, hey, stop paying me, send my paycheck to my 10-year-old.
Right, that would just be chaos, a free-for-all, basically. Exploiting lower tax brackets like that, it's not allowed.
So earned income is off the table. But where's the loophole?
Ah, that's the key. It was with unearned income. And that's exactly why the Kiddie Tax exists. Think about investments, right? Money you have maybe in a CD, a certificate of deposit, earning interest.
Okay.
Or maybe you own stocks and they pay out dividends. That's all unearned income. You didn't work directly for it in the same way as a salary. And before the Kiddie Tax, yeah, it wasn't unheard of for parents to put these kinds of assets in their child's name.
Right, I see.
The thinking was, great, my kid pays tax on this income, but at their much lower rate, saves the family money overall.
Makes sense from their perspective.
Sure. But Congress saw this as, well, a pretty significant way to avoid taxes. So the Kiddie Tax was created specifically to limit shifting that kind of income, the unearned kind. That distinction is crucial.
Okay, and there's this analogy from the source material, the Griffins, like Peter Griffin.
Yeah, it's a good illustration.
So Peter's probably earning a decent amount, high tax bracket.
Let's assume, yeah.
And he thinks, why don't I put some of my investment money in, say, Max's name?
Right.
Or Chris's, or even Stewie's, hoping they'd pay maybe, 10% tax instead of his 25% or whatever it is.
Exactly. And the Kiddie Tax is designed precisely to stop that kind of large-scale shifting. Now, it doesn't mean no shifting is possible. You can still take advantage of a child's initial low or zero bracket for a small amount of unearned income.
Okay.
But the key takeaway is that it's very limited. It's definitely not a free pass to avoid taxes on investment income.
Got it. So if the aim is stopping parents using their kids' lower rates, who exactly counts as a kid for this tax?
Oh.
It's got to be more than just being young, right? What are the rules?
Good question. Yeah, the IRS has three main conditions you need to look at. First, pretty simple. It applies to any child who hasn't hit age 19 by the end of the tax year. So definitely minors.
Okay, under 19. What about older kids? Like college age?
Right. So condition two, if they are over 19 but still under 24, they also need to be a full-time student.
Full-time student.
Yeah, for at least 5 months during that tax year. So we're generally talking about college students here, people still somewhat dependent, not just, any 22-year-old out there.
Okay, that makes sense. But what if the child is actually supporting themselves? Maybe they're 20, a student, but they have a great part-time job or something. Does the Kiddie Tax still hit them?
That brings us to the third condition, and it's really important. The child must not provide more than half 50% of their own support.
Okay, the support test.
Exactly. Because if a child, even if they fit the age and student criteria, is genuinely supporting themselves for the most part, and they happen to have unearned income, well, that's generally seen as their own income.
Right.
The Kiddie Tax probably wouldn't apply then, because remember the goal. Stop parents shifting their income. It's not meant to penalize a truly independent young adult who happens to have some investments.
So it prevents parents from just dumping a huge investment portfolio on their, say, 23-year-old kid who's still living at home and totally dependent just to get the lower tax rate.
Precisely. It targets that dependency link.
Okay. Is there any situation where the Kiddie Tax just doesn't apply at all? An escape hatch.
Yes, there is one key exception we should mention. The kiddie tax does not apply if the child is married and files a joint tax return with their spouse.
Ah, married filing jointly.
Right. Once they're married and filing together, they're sort of seen as their own independent tax unit. The kiddie tax rules just step aside at that point. They've effectively graduated from it in the eyes of this specific law.
Okay, interesting. Now, this is where it gets really, really practical for people listening. Maybe you're doing financial planning, maybe studying for an exam. What's the actual number, the trigger point?
Right.
Because you said it's not all unearned income, just amounts above a certain level. What's that magic number?
Exactly. There's a threshold. The kiddie tax kicks in if a child has more than $2,300 in unearned income.
$2,300.
No, super important point. That specific number, the $2,300, it changes. It's indexed for inflation, so it can creep up year to year. You always need to check the current year's amount.
Good reminder. Always check the latest figures.
Definitely. But the principle stays the same. And what's really interesting is how they get to that $2,300 figure. It tells you a lot about what the tax is targeting. So let's break down that $2,300. It's kind of made up of two distinct parts. The first, $1,150 of a child's unearned income. It's completely tax-free, 0% tax. Think of it like a little gift from the IRS.
Okay, $1,150 tax-free. Nice.
Then the next $1,150 of unearned income gets offset or sort of wiped out by the child's standard deduction.
Ah, the standard deduction.
Right. Everyone gets a standard deduction, basically an amount of income that isn't taxed. For a dependent child, how this is calculated can be a bit tricky involving their earned income, but for this initial threshold calculation. The key thing is that the second $1,150 chunk is covered by that standard deduction.
So the first $1,150 is zero tax. The next $1,150 is covered by the deduction. Add them up.
And you get $2,300. So effectively, the first $2,300 of unearned income doesn't result in any tax for the child, or it's taxed at the potentially very low rate.
Okay, so what happens above $2,300?
That's where the kiddie tax really bites. Anything above that combined $2,300 threshold is subject to the kiddie tax. And this means it gets taxed at the parent's higher tax rate.
A parent's rate. Ouch.
Exactly. So that $2,300 threshold, it seems small, but it's a clear line. Below it, okay. Above it, we're looking at the parent's tax situation. It shows the focus isn't on, birthday money or a tiny savings account. It's aimed at more substantial investment income being shifted.
That makes it much clearer. It's a specific zone before the parent's bracket matters. Okay, so if the kiddie tax does apply, how does this actually get reported? Does the kid need to file their own complex return, or does it just flow onto the parent's return somehow?
Well, you actually have a choice. There are two main options, which gives families a bit of flexibility. Option one, the income can be reported on a separate tax return filed for the child.
Okay, the child files.
Yeah. And on that return, the portion of income below the kiddie tax threshold is taxed at the child's rate, and the amount above the threshold, the kiddie tax portion, is also calculated on their return, but using the parent's tax rate.
Okay, so it's all on the child's return, but using two different rates.
Correct. Option two is that the parent can elect, they can choose, to report the child's unearned income directly on their own tax return.
Ah, okay. How does that work?
They'd report it typically as assigned interest and dividends on their Form 1040, and in that case, the parents just pay all the tax due on that income along with their own taxes.
Simpler, maybe, but the parents pay directly.
Could be simpler, yeah. Depend on the situation.
Now, I know for a lot of folks listening, especially if you're deep in accounting studies or prepping for the CPA exam, most examples you see tend to keep it simple, right? They focus on kids with no earned income, just that passive, unearned stuff.
Very common scenario in textbooks, yes.
But here, we like to get into the real world stuff too. So what happens when the child does have earned income? Maybe they have a part-time job after school, plus the unearned income. That must change things.
Oh, it absolutely does. And it primarily changes things because of the standard deduction we mentioned earlier.
Right. You said the calculation could change.
Exactly. When a child is working and has earned income, their standard deduction calculation is different. If they earn only a small amount, say less than $750 or so, their standard deduction usually stays at that base level, that $1,150 we used in the threshold.
Okay.
But if they earn more than that, maybe they make $6,000 or $7,000 from a summer job or part-time work, Then their standard deduction becomes their earned income plus $400.
Earned income plus $400. So if they earn $6,000, their deduction is $6,400.
Correct. Up to a certain limit, of course. There's always a maximum standard deduction for any single individual. In the illustration we're drawing from, that max was around $12,950.
And that maximum also changes each year.
That also changes each year, yes, just like the kiddie tax threshold. The key point, though, is that having earned income can give the child a much, much larger standard deduction.
And a larger deduction means less taxable income overall.
Precisely. Which then affects how much of their unearned income ends up being subject to the kiddie tax at the parent's rate. It gets a bit more involved.
That's a really critical detail. Okay, this feels like the perfect time for an example. I think seeing the numbers move really helps lock this in.
Agreed. Examples are key here.
Let's use Adam. He's 17, single, doesn't provide more than half his own support. Sounds like a prime kiddie tax candidate.
Perfect. Okay, let's do scenario 1. Adam with only unearned income. No job, just investments. Let's say Adam has $6,200 in unearned income for the year. Dividends, interest, whatever.
Okay, $6,200 unearned.
How is it taxed? Well, we know the first $2,300 is effectively tax-free or taxed at his low rate. Remember, that's the first $11,150 at 0% tax, and the next $1,150 offset by his standard deduction, which is $1,150 in this no-earned income case.
Right, the $2,300 threshold.
So we take his total $6,200 unearned income, and we subtract that $2,300 threshold amount. $6,200 minus $2,300 leaves $3,900.
$3,900.
That $3,900 is the amount subject to the kiddie tax. It's taxed at his parents' higher tax rate.
Got it. So $2,300, the $3,900 above that gets the parents' rate applied.
Exactly. In this simple case. Now, let's make it more interesting. Scenario 2. Adam with both unearned and earned income. He still has the $6,200 in unearned income, but now let's say he also worked part-time and earned $3,000.
Okay, $3,000 earned income added to the mix.
First thing that changes. His standard deduction, remember the rule, earned income plus $400.
Right, so $3,000 plus $400, it's $3,400.
Correct. His standard deduction is now $3,400, much bigger than the $1,150 before.
Okay.
Next, figure out his total income, his gross income. That's $6,200 unearned plus $3,000 earned.
$9,200 total.
Yep. Now apply his new larger standard deduction. We take the $9,200 gross income and subtract the $3,400 standard deduction.
$9,200 minus $3,400 is $5,800.
$5,800. That's Adam's preliminary taxable income. But we're not done, because we have to apply the kiddie tax logic to the unearned part.
Ah, right. The unearned income still has that special treatment.
It does. So we look at his $6,200 of unearned income. Just like before, the first $2,300 of it is sort of protected taxed at his low rate or zero.
Okay.
So $6,200 unearned minus that $2,300 threshold still gives us $3,900. That $3,900 chunk of his unearned income is taxed at the parent's rate.
Still $3,900 at the parent's rate, even though he has earned income.
Yes, the amount subject to the parent's rate calculation, $6,200, $2,000, $2,300, remains the same in this case, based purely on the unearned income exceeding the threshold. But here's the difference. How much income is left to be taxed at Adam's rate? We calculated his preliminary taxable income was $5,800, right?
Yeah, $5,800.
We know $3,900 of that is being taxed at the parent's rate. That's the kiddie tax portion. So we subtract that out. $5,800 minus $3,900 leaves $1,900.
$1,900.
But $1,900 is what's left. That amount is taxed at Adam's own individual tax rate, which is probably the lowest bracket, maybe 10%.
Okay, so having the earned income didn't change the amount taxed at the parent's rate in this example. But because it increased his standard deduction, it reduced the amount of his other income, the earned income and the first bit of unearned income that was subject to tax at his rate.
You got it. The earned income boosted his standard deduction, sheltering more of his overall income, $19,200 gross, from tax initially. Even though the $3,900 unearned piece is still carved out for the parent's rate, the remaining taxable income, $1,900 taxed at his rate, is derived from both his earned income and the initial protected part of his unearned income, shielded by that bigger deduction.
Wow. Okay, that really shows how having earned income interacts with these rules. It's not just additive, it changes the base calculation through the standard deduction.
Exactly. It demonstrates why you really need to work through the steps, especially calculating that standard deduction correctly when earned income is involved.
Yeah, those examples make a huge difference. Just reading the rules is one thing, but seeing the numbers flow really clarifies it. It hammers home why you need concrete examples like the ones on farhatlectures.com to really get it.
Absolutely. And the big picture message from all this complexity, The Kiddie Tax works. It does prevent significant tax avoidance by limiting that income shifting, especially the unearned kind. And understanding these details, these nuances, it's not just academic. It's really crucial for families doing financial planning.
Yeah.
If you have kids with investments, maybe trusts, or you're thinking about making significant financial gifts,
You need to know this stuff.
you really do. It helps make sure you're compliant, obviously, but also that you're making informed choices about your family's finances. It might explain why things like 529 college savings plans are so popular, right?
Because they have their own tax rules.
Exactly. They're designed specifically for education savings and generally bypass these kiddie tax rules completely. Different set of regulations.
Interesting connection. Okay, so for everyone listening, here's something to chew on. Think about the implications of the kiddie tax. Even for something that seems simple, like gifting some stocks to your child, how might these rules change the way families save or invest for their kids? Does it push them towards specific account types, like a 529, just to avoid triggering these rules?
Yeah.
It really shows how tax law can subtly, or not so subtly, shape our financial behavior.
It's a great point. And to really master these rules and calculations, I strongly encourage you. Invest in yourself, invest in your career. Head over to farhatlectures.com. Professor Farhat has tons of practice questions, true, false, exercises, everything you need to really deepen your understanding. Whether you're aiming for the CPA, you're an enrolled agent, or an accounting student, it's an invaluable resource. Keep learning, keep practicing.
Absolutely sound advice. Well, that wraps up our deep dive into the kiddie tax for today. We really hope you feel more informed and maybe a bit more confident navigating this tricky area of tax law. Thanks for joining us, and we look forward to the next exploration with you.